Welcome to Lesson 2.4, where we'll discuss how to choose the best type of investor for your business. On your marks, get set, bang! We all recognize this as a familiar way that races start, but what does that have to do with raising capital? When you enter a race, you're mentally prepared to cover as much ground as fast as you can. You are keenly aware that every second counts and every stride has to be productive. Approach raising capital with the same mental attitude. Time is equal to money. Investors who are focused on return on investment, or ROI, want you to build as much value in your business in as short a time period as you can. That's because ROI is a function of both value and time. Of course, many investors want to place their bets on the fastest horses because that has the possibility of producing the highest ROI. But all businesses can't be the fastest one in the race. Some industries grow faster than others. It's easy to grow fast if your market is growing 50% a year than if it's growing just 10% a year. So does that mean you have no chance to raise capital if you aren't in a fast-growing industry? The answer is no. Luckily for you, your potential ROI isn't the only thing that investors look at. For many investors, limiting their risk is more important than investing in businesses with the highest potential ROI. They're willing to settle for a lower potential ROI if your business is a lower risk. A slow and steady horse will be highly likely to finish the race, is often more appealing than horses that start fast but break down before the race ends. So when you look at the world of investors, break investors down into ROI and risk categories. Then evaluate your business by ROI and risk. Your sweet spot is the investors whose ROI and risk profiles most closely match the profile of your business. Once you've done that, it's easy to navigate the world of investors. Analyzing the risk-reward profiles helps you navigate through the world of financial investors. Strategic investors also consider how your business helps their existing businesses. Financial investors usually offer a lower valuation than strategic investors because financial investors get no benefit other than ROI. But return on investment is usually only part of the benefit that strategic investors want. And remember that it's not always an all-or-nothing choice. Investment rounds sometimes mix different capital sources that seek different risk levels for different rates of return. They are combined into one capital raising round by selling different types of securities that afford different levels of risk protection. You will probably give up a bigger percentage of your company if you rely solely on traditional venture capital investors than if you raise all or some of your capital at better prices from alternative capital sources. Venture capital investors often help you tap into these lower-priced alternative capital sources after they join your board of directors because it helps reduce their own dilution. So, if your business is a good match for less expensive capital sources, you'll be more attractive to venture capital investors. So let's begin talking about the many different types of investors and what each type of investor is looking for.